focuses on the investment analysis report, the 1,000% gainer, why Opendoor, OPEN, is the comeback stock of the year, which assesses the sustainability of Opendoor's massive stock rally.
A rally from, what, 51 cents up to almost $7?
It's a huge move. And look, this is a sharp, balanced report. It really captures the high-stakes feel of this stock.
Absolutely. It's got both sides of the coin.
So let's just dive right into the core of the financial argument. We think resequencing one crucial piece of information can really elevate the whole thing. The report makes a strong point in the financial reality check section. It notes that the huge, $887 million free cash flow is misleading.
Fundamentally misleading, yeah.
Because, as the notes lay out, this cash flow came from selling off about $1 billion in inventory. It's a one-time liquidation.
Right. Well, the company still posted a net loss of $90 million in the third quarter.
Exactly. Now, the report lays out that contradiction, but I'm worried that by burying it mid-analysis, it sort of suggests the analytical gravity wasn't fully appreciated.
I agree. You see that big cash flow number up top and you think one thing. The reality is something else entirely. Does putting it in the middle minimize the tension you need to set the tone?
It absolutely does. The weakness here is that this foundational contradiction, positive FCF from just selling stuff off versus a $90 million operating loss, it's detailed in a middle section.
Which just kills the immediate impact.
It does. It diminishes the tension you need to frame the whole analysis, especially since a big FCF number often triggers, immediate but sometimes superficial investor excitement.
So the report's analytical weight really rests on establishing the true nature of that cash immediately.
Yes.
So the suggestion then is to resequence the financial arguments. You have to foreground that critical distinction right away.
Bring it up front.
Bring it all the way up front. The report needs to make sure that the core challenge, that Opendoor is shrinking to survive, not growing profitably, is established right after the executive summary.
It just elevates the rigor of the whole analysis from the very beginning. It manages expectations about that huge cash pile.
It's really about the integrity of the data presentation.
Exactly. If the analysis starts with a cash figure without that context, you're immediately anchored to an optimistic but false premise.
So how do you do that?
Well, one concrete way is to make sure the executive summary explicitly flags that the cash pile is a result of inventory reduction. Just a line saying they went from roughly $2 billion down to $1 billion.
And you contrast it directly with the shrinking revenue?
Contrast it directly with the shrinking revenue, which dropped to $915 million in Q3. That juxtaposition sets a much more rigorous tone.
And it forces you to view the next sections, like the whole AI pivot, through a lens of desperate necessity, not just pure innovation.
Right.
You could also use maybe a visual metaphor, something in the summary to really drive the point home.
Oh, I like that.
Emphasize that they're converting trapped cash from illiquid assets, not generating profit, like describing the FCF as cashing out the furniture before the house is fixed.
That's good. That immediately justifies the financial reality check section later on.
And it's critical because, for a financial company, positive FCF usually signals health. Here, it signals a strategic retreat. That distinction has to be front-loaded.
Okay, so that financial sequencing sets the table perfectly, demands a more critical eye. But now let's talk about how the analysis can leverage some of the signals management itself is sending.
The warrant dividend.
Let's move to that fascinating warrant dividend. The report notes that in November 2025, the company issued this, framing it as a major confidence signal from the CEO.
Giving shareholders the right to buy stock at higher prices, $9, $13, and $17?
Exactly. But right now, the analysis just kind of treats those numbers like historical trivia.
Not as future KPIs. Yeah, is there a risk that presenting it solely as a positive psychological signal, that it overlooks its use in actually quantifying management's conviction?
Or its impact on future valuation models. Those aren't arbitrary numbers, they're strike prices.
Precisely. And that's the weakness. The section on the warrant dividend is currently treated like an isolated, interesting fact, A compelling anecdote, maybe.
Yeah, a piece of trivia.
Right, instead of being fully integrated into the bull case valuation argument or even the risk analysis. Potential dilution, future cash influx, all of that.
So to maximize the analytical impact, the suggestion here is pretty clear.
Directly incorporate those warrant strike prices into the valuation arguments.
Quantify what management is saying.
You have to quantify it. This is management giving the street a direct roadmap. They're basically saying, we believe we're worth $9, then $13, then $17 as we hit these milestones for Opendoor 2.0.
And the analysis should treat those as non-negotiable goalposts. It grounds the bullish enthusiasm in hard numbers that the company itself provided. That's essential for credibility.
So what's a concrete way to do that?
Well, one way is for the analysis to compare the current price, around $6.99, against that lowest strike price of $9.
Highlighting the gap.
It explicitly highlights the gap between the market's valuation and what management implies is the immediate floor. It transforms a simple confidence signal into a concrete analytical threshold.
And that gap from, let's say, $7 to $9, that represents management's conviction that their turnaround should have a 28% upside.
Just to hit the first milestone.
Just the first one. Then the analysis could specifically tie the higher strikes, the $13 and $17, to the core thesis of the Opendoor 2.0 pivot.
Okay, so you're arguing that those higher strikes represent the moment Opendoor gets valued like a tech company.
Exactly, not a capital-heavy home flipper. It gives the reader tangible, company-issued metrics to watch for. It's confirmation that the tech transformation is actually working.
It provides a clear framework for what a successful return on investment should even look like.
Right.
Connecting management's specific financial targets to the strategic thesis is a powerful move. Now, let's talk about executing that strategy and how it interacts with the real world.
External realities.
Yeah. Our third area for refinement is all about connecting the company's internal pivot to the biggest market risks.
Okay.
The core bullish thesis rests on Opendoor 2.0. This AI pivot, transforming the company from a manual home flipper into an asset-light, AI-first tech platform.
And the core insight there is strong. I mean, that's the genius in this analysis.
It is. But the bear case later counters it so effectively by just stating the housing market is still frozen. If they can't sell homes, their AI doesn't matter.
And that's the knockout punch if you don't address it. The material makes a really compelling case for the tech shift, the move away from high-risk real estate. But for this to be truly persuasive, the argument linking the AI pivot to mitigating that market risk has to be stronger.
It has to be explicit.
It has to be. Right now, the two major sections, the tech thesis and the housing risk, they're basically operating in silos.
Which makes that bear case counter argument dangerously potent.
It really does.
And that separation is the key weakness here. The technological benefits, the speed, the cost-cutting, the automation, they aren't explicitly framed as solutions to the risks in the bear case.
There's an analytical disconnect.
Totally. And it leaves the tech pivot vulnerable to that cyclical housing market critique. It makes it easy for a skeptic to dismiss the whole strategic shift as irrelevant noise if interest rates stay high.
So the analysis has to prove that Opendoor 2.0 isn't just a better way to operate, but that it's a necessary survival mechanism against these economic headwinds.
Exactly.
To overcome this, the suggestion is to restructure that whole strategic deep dive, explicitly show how the AI and automation features are designed to mitigate the primary challenge of a frozen housing market.
You have to force the connection.
You have to. You have to connect the internal improvements directly to the external realities. You have to prove that the AI matters even if the market is frozen.
Okay, so we need to illustrate how this new operational model builds resilience against market lockup.
Right, how specifically?
For instance, the analysis could explain that the AI-driven assessments minimize the risk of getting stuck with badly priced inventory. That's a huge danger in a slow market, right?
It's the biggest danger.
Compared to the old error-prone human model, if transactions are scarce, the cost of one single error just skyrockets.
So the AI's precision directly addresses the liquidity risk that's cited in the bear case.
Yes. It shifts the operational risk away from just bad underwriting and more toward macro factors, which is a better story.
A powerful alternative there, or maybe something to add, would be to emphasize how drastically cutting overhead costs via automation directly supports the shrinking to survive strategy.
Okay, I see where you're going.
This strengthens the whole argument by showing that even if Q4 revenue continues to drop, the cost restructuring lets the company sustain operations for much longer.
You're saying link the automation savings directly to their ability to hit that adjusted net income break-even goal by late 2026.
Exactly. That link makes the AI pivot essential to market resilience and cash preservation, not just operational efficiency. In a down market, it's the cost cutting that ensures survival, not just the revenue generation.
That's a fantastic point.